Three separate alarm bells just rang in the precious metals market, and they all rang at the same time. First, Mexico, the world's largest silver producer responsible for roughly 25% of global supply, just mobilized its military, shut down airspace in multiple regions, and canceled flights after reportedly taking out a major cartel leader. Second, PAXG, the gold-backed cryptocurrency that trades 24/7. Each one of these signals, in isolation, would be worth paying attention to. But when all three converge in a single weekend while Shanghai is closed and liquidity is at its thinnest, you have the setup for a potential gap higher in silver that could blow past the $86.30 technical objective and push straight into the $87 to $89 resistance zone without giving traders a chance to position. Let me walk you through what each of these signals means, why they matter, and what the convergence could signal for silver in the days ahead. Military mobilization in the world's largest silver producer, Mexico, produces approximately 1 in every 4 ounces of silver mined globally. That is roughly 25% of total global mine production. When you control that much of a globally traded commodity, any disruption, real or perceived, has the potential to reprice the entire market. Over the weekend, reports emerged that Mexico mobilized military forces, shut down airspace in parts of the country, and canceled commercial flights following what appears to be a major operation targeting cartel leadership. The details are still emerging, but the fact that military assets are being deployed and airspace is being restricted tells you this is not a minor law enforcement action. This is a significant security event in a country that produces a quarter of the world's silver. Now, to be clear, we do not yet have confirmed reports of actual silver mine shutdowns or production disruptions. This is not, at least not yet, a documented supply shock. But in tight commodity markets, uncertainty itself can reprice assets. The silver market is already structurally tight. Speculative long positioning is near 20-year lows, meaning there is very little speculative froth in the market, and most of the buying is coming from physical demand or industrial users. Shanghai premiums have been elevated, signaling strong Eastern physical demand. And the paper price is sitting at $84 during a period of maximum uncertainty about the world's largest producer. If even a portion of Mexican silver production were to be disrupted, whether due to security concerns, transportation issues, or logistical complications from military operations, the impact on global supply would be immediate and significant. Silver is not like oil, where there are massive strategic reserves, and alternative suppliers can ramp up quickly. Silver mine supply is relatively inelastic. You cannot just turn on new production overnight. So when 25% of global supply sits in a country experiencing military mobilization and airspace shutdowns, the risk premium alone can drive prices higher, even before any actual disruption occurs. Gold-backed crypto trading, above Friday's Western close on Sunday, before Western futures markets open for the week. PXG, Paxos Gold, a gold-backed cryptocurrency that trades 24/7. PAXG is a tokenized version of physical gold, where each token is backed by 1 troy ounce of gold held in allocated storage. It trades continuously on crypto exchanges, which means it can react to news and events in real time, even when traditional futures markets are closed. And on Sunday night, PAXG was telling you that global buyers were willing to pay $50 more per ounce than Friday's Western close to secure gold exposure immediately. Now, does a PAXG premium guarantee that Western gold futures will gap higher when they open Monday? No. Crypto markets are thinner, more volatile, and can overreact to headlines. But a $50 premium is not noise. That is a directional signal that something has shifted in the risk environment over the weekend, and that buyers believe gold is worth more than the closing price suggested on Friday. What shifted over the weekend? The Mexico crisis. The COMEX February gold anomaly becoming more visible as traders dug into the data. The ongoing geopolitical tensions in the Middle East, with Iran's uranium enrichment being diplomatically accepted. While U.S. military assets move toward the region in what some analysts are calling the largest military buildup since 2003. And the broader monetary regime shift narrative, where the dollar's reserve share has fallen to a 32-year low, and central banks now hold more gold than U.S. treasuries for the first time since the mid-1990s. All of those factors create an environment where weekend news can reprice assets before Western markets open, and PXG was pricing that shift at $50 per ounce, 24x. Average open interest in only 134 contracts traded Friday. Now let's talk about what may be the most significant and most underreported story in precious metals right now, the COMEX February gold contract anomaly. As of Friday's close, the February gold contract, which is now just days away from final settlement, still had 436,000 ounces of open interest. That is equivalent to approximately 13.5 tons of gold. For context, that is 24 times the average open interest you would normally see at this stage of a delivery cycle. Even more striking, The February contract open interest is larger than the March contract, which is the next active delivery month. That is statistically abnormal. Normally, as a contract approaches final settlement, open interest collapses, as traders either roll forward into the next month, close out their positions for cash, or stand for delivery and take the metal. But the February contract is not behaving normally. It is holding massive open interest with very little trading activity. On Friday alone, only 134 contracts traded in the February gold contract. That is extremely thin liquidity for a contract with 436,000 ounces still open. When you have large open interest and very low trading volume, it suggests that someone is stuck in a position they cannot easily exit, or that they are deliberately holding the position because they intend to either deliver or take delivery of physical metal. This raises a critical question. Is there a large short position that is unable to exit? And more importantly, does that short have the physical metal to deliver if the longs stand for delivery? This is not speculative conspiracy theory. This is observable market data combined with historical precedent. In September 2020, JP Morgan paid a $920 million settlement to resolve charges of precious metals spoofing and manipulation. The CFTC has documented repeated enforcement actions against major banks for manipulating futures markets. So when you see a contract with 24 times normal open interest, larger open interest than the next active month, and only 134 contracts trading on a Friday, it is reasonable to ask whether there is a trapped short and whether that short can deliver if called upon. If the answer is no, if a large short cannot deliver physical gold, then the February contract could become a forced squeeze where the short is compelled to either buy back the position at any price or default. And if a major player defaults on a COMEX gold contract, the credibility of the entire futures market as a price discovery mechanism comes into question. Why timing matters for potential gaps. Now add one more layer to this setup. Shanghai is closed Monday and does not reopen until Tuesday. That creates a thinner liquidity environment in global precious metals markets at exactly the moment when multiple risk signals are flashing. Shanghai has become one of the most important price discovery mechanisms for physical gold and silver. When Shanghai is open and premiums are elevated, it puts upward pressure on Western paper prices because arbitrage traders cannot ignore a persistent physical premium. But when Shanghai is closed, that anchor is temporarily removed and Western paper markets can move more freely in either direction. Normally, reduced liquidity is a stabilizing factor. But when you combine thin liquidity with a Mexico supply risk of $50 PAXG premium and a 436,000 ounce COMEX gold anomaly, thin liquidity becomes an amplifier. If buyers come in aggressively when the market opens Monday, there may not be enough sellers at current prices to absorb the demand. That creates the conditions for a gap higher, where price jumps from one level to another without trading the levels in between. Tuesday, when Shanghai reopens, will be a critical price discovery moment. If Shanghai physical premiums remain elevated or widen further, it confirms that Eastern buyers view current Western paper prices as too low and are willing to pay significantly more for physical metal. If premiums compress, it suggests the weekend risk premium was overblown and the market is stabilizing. What it takes to break out versus consolidate. From a technical perspective, silver is currently trading at $84 with a clear next objective at $86.30. Above that, you hit the major resistance zone between $87.20 and $89. This is the range where silver has historically struggled to break out and where significant selling pressure tends to emerge. What determines whether silver breaks through that resistance decisively or consolidates below it? Momentum and conviction. If silver approaches $87 to $89 on a slow grind with weak volume, it is likely to consolidate or reverse. But if silver gaps into that zone on high volume driven by a Mexico supply scare, a COMEX delivery squeeze, or a broad precious metals breakout following gold's move higher, then the technical setup favors a decisive breakout rather than a failed rally. The key distinction is whether the move is driven by speculative positioning or by physical demand and structural tightness. Speculative moves can reverse quickly when momentum fades, but moves driven by physical shortage, supply risk, or delivery stress tend to be more sustained because the underlying imbalance cannot be resolved by simply selling futures contracts. You cannot deliver paper silver to an industrial buyer who needs the metal for manufacturing. Right now, speculative long positioning in silver is near 20-year lows. That means the current price level is not being driven by speculative froth. It is being supported by physical demand, industrial buying, and structural tightness. That is a much healthier foundation for a breakout than a market that is overextended on speculative leverage. Dollar reserve share at 32-year low. Central banks. Choose gold over treasuries. Now let's zoom out and talk about why all of this is happening in the first place. Because the Mexico crisis, the PAXG premium, and the COMEX anomaly are not isolated events. They are symptoms of a larger structural shift in the global monetary system. The US dollar's share of global reserves has fallen to a 32-year low. At the same time, central banks around the world now hold more gold than US treasuries for the first time since the mid-1990s. That is not a minor shift. That is a fundamental reordering of how sovereign nations store value and manage reserves. What triggered this shift? Many analysts point to the seizure of Russian foreign reserves following the Ukraine conflict. When Western governments froze Russia's dollar-denominated assets, it sent a signal to every other sovereign nation. Dollar reserves can be weaponized and confiscated. Gold cannot. Physical gold held in your own vaults cannot be seized by a foreign government. That realization has accelerated the global rotation from treasuries into gold. At the same time, geopolitical tensions are escalating. Iran's uranium enrichment has been diplomatically accepted even as U.S. military assets are moving toward the Middle East in what is reportedly the largest military buildup since 2003. Energy choke points like the Strait of Hormuz remain vulnerable. Trade conflicts persist. And fiscal trajectories in the US and Europe remain unsustainable, with debt levels continuing to rise and interest burdens consuming larger shares of government revenues. All of these factors create an environment where gold and silver are not just commodity trades, they are monetary hedges against systemic instability, currency debasement, and geopolitical risk. And when that narrative gains institutional traction, it does not reverse easily because the underlying structural drivers do not go away. Honest risk assessment. Let's be intellectually honest about the risks, because risk management requires acknowledging scenarios where the bull case does not play out as expected. First, the Mexico situation has not yet resulted in confirmed mine shutdowns or documented production disruptions. It is a risk, not a realized event. If the military operation concludes quickly and mining operations continue normally, the supply risk premium could evaporate just as fast as it appeared. Second, thin liquidity cuts both ways. Yes, it can amplify moves higher if buyers are aggressive, but it can also amplify reversals if large sellers emerge. A gap higher can become a gap lower just as quickly if the fundamental drivers do not hold. Third, bullion banks have historically been able to resolve delivery stress through procedural mechanisms, cash settlements, rollovers, margin adjustments, and other tools designed to prevent actual defaults. The COMEX February gold anomaly could resolve itself without a squeeze if the short is able to secure physical metal, or if longs are incentivized to roll forward or settle in cash. Fourth, timing risk is real even if the directional thesis is correct. Silver could consolidate at $84 for weeks before breaking higher. Traders positioned for an immediate gap could be stopped out before the move occurs. All of those risks are real and should not be dismissed, but they do not invalidate the convergence of signals. They simply mean that the path forward is uncertain and that risk management, position sizing, stop placement, and avoiding over-leverage remains critical. Is this the setup for silver's next leg higher? So here's where we are. Mexico, responsible for 25% of global silver production, has mobilized its military and shut down airspace. PAXG is trading at a $50 premium over Friday's Western gold close, signaling that 24/7 markets believe gold is worth more than the paper price suggested. The COMEX February gold contract is showing 436,000 ounces of open interest, 24 times the normal amount at this stage, with only 134 contracts trading on Friday, raising questions about whether a large short is trapped and whether they have the metal to deliver. Shanghai is closed Monday, creating thin liquidity conditions. Silver is sitting at $84 with a technical target at 86.30 and major resistance at 87 to 89. Speculative positioning is near 20-year lows, meaning the market is not overextended. The dollar's reserve share is at a 32-year low. Central banks hold more gold than treasuries. And the broader geopolitical and monetary backdrop continues to favor hard assets over fiat paper. Does all of this guarantee that silver gaps higher Monday morning and breaks through 87 to 89 in a single move? No, markets do not offer guarantees. But the convergence of a Mexico supply risk, a weekend PAXG premium, and a statistically abnormal COMEX gold contract, all occurring, while Shanghai is closed and liquidity is thin, creates the conditions for a volatile directional move that could catch traders off guard. Watch Tuesday when Shanghai reopens. Watch the COMEX February gold contract as it approaches final settlement. 3 alarms are ringing. The question is whether the market is listening.